Leslie Picker has some more on the traditional IPO and now this new direct listing. Leslie.
Hey, that's right, John. So just to start, let's take a step back and explain what a direct listing has meant historically, and then we'll go into what yesterday's announcement about some changes to the direct listing process could mean. So companies like Palantir, Spotify, Slack, Asana, all have taken this route, which is different from a traditional IPO because they don't use underwriters and haven't historically been able to sell their own stock in the transaction. Only prior shareholders could sell, and the opening price was made in the market rather than through a traditional roadshow. Yesterday's SEC approval of the NYSE proposal would allow companies to actually raise capital concurrent with their direct listing, solving for perhaps the biggest deterrent for many companies in actually choosing this method because they want cash from an IPO. Now, the news was a huge win for venture capitalists who have been championing this method, notably Benchmark's Bill Gurley.
I think it'll be very hard for anyone to argue whether it's a traditional IPO or a SPAC that's going to be better than a direct listing with a primary offering. This is so elegant, so efficient. It actually has fewer steps than an IPO. It's wonderful. I do think every single company will move this route.
Here's the problem, though. I called some of the top IPO advisors, bankers, and lawyers yesterday, and no one knows exactly how this is going to work. So if a company were to target, say, a $500 million fundraise amounting to a 10% float or 10% of their market cap, and then the stock actually opens at half of that level that they expected, they're looking at double the dilution. Without a set IPO price and without underwriters to stabilize the deal in the aftermarket, there could be additional liability on the issuer, as well as greater uncertainty and lack of control over the trading, which could have pretty big repercussions, if things turn out to be not as they planned, John.
Yeah, those are some significant issues. Leslie, thanks. And we're going to stick with those and bring in Steve Jang, who is the founder and managing partner of Kindred Ventures. Steve, Leslie laid out some pretty big questions that are still hovering above this direct listing possibility. How important are those questions to you?
I think those are important questions. I think the first thing to know about direct listings is that what it does is democratizes access to the everyday, the retail and the small institutional investor, where historically it's been really the domain and under the control of large institutional investors. So number one, that opens up the aperture for everyone to participate rather than the day after. The other important thing to note is that this is probably going to be really, really good and beneficial for the company that has great prospects in going public. I don't think for the companies that aren't well understood by the investor market, that need that stabilization activity from the banker and the underwriter. It may not be the right method, but if you're a tech IPO, you're probably already on a great trajectory. The market understands and sees you coming down the line. I think primary direct listings are an amazing new invention that, frankly, Bill has fought the good fight there. The New York Stock Exchange has been doing great work on SPACs as well as direct listings. And the SEC approval of this is great. I mean, this is a 100% net benefit to the tech ecosystem.
Shepard Smith here. Thanks for watching CNBC on YouTube.